Good morning. It is 11 o'clock on Saturday, May 6th. It's amazing to think it's May 6th already. My name is Ken Crotty, and I am here to walk you through Cuperts and Grats in 60 minutes flat. A couple of items to talk about. One is that I'm going to go ahead and just use the screen as is instead of the camera. The main thing is that my ventriloquism and my dummy skills are nowhere near equal to what Alan possesses, and I mean that in a good way. But the other thing too is we do have some slides here where we're going to go through some math examples, and I thought it'd be easiest to have everything on the full screen. So again, we're going to talk about Cuperts and Grats in 60 minutes. A couple of housekeeping items. Just to let you know, if you were trying to get CPA credit for this, and it's something that needs to have been done ahead of time, but this is more housekeeping in the sense so that it can help you the next time to make sure you do this properly if you are trying to get credit for it. But what you need to do is to log in to the webinar to get CPA credit, as you see on the instructions on this screen, by going to here and logging in accordingly. The wrong way to do it is to go through what you see on this screen by just clicking the join the webinar. That's not going to get you CLE credit. You're still going to see the same fabulous presentation, but you're not going to get the credit for it. And then again, we're just kind of have the same notes here for future attendees about what the presentation qualifies for CLE and what it doesn't. It's self-explanatory. So again, that's for future attendees. It has nothing really to do with today's presentation as far as trying to qualify. Unfortunately, you're either qualified or you're not. And either way, you are stuck with me for another 59 minutes. But we'll try and make it not too painful, especially with how beautiful the weather is outside today. And hopefully some of you actually have a setup where you're able to do this outside, because that would be the best of both worlds. All right, so one thing that's important, this is a live webinar, so if you do have a question, assuming it's an easy one, I will try to answer it. To actually ask the question, we have the instructions here. You can click on the red arrow, which you see at the top of the screen, and follow the directions. The question drop bar down there at the bottom will pop out, and then you will be able to ask any questions. And like I said, I will do my best to answer them. I'll try to do my best just to answer them as they come in, and we'll go from there. All right, a couple of other items to talk to you about. One item to let you know is we do have a Thursday report, which we publish. I actually will be publishing that this month as well, so you'll be sick of me by the time the month is over. But it is a good vehicle to learn some interesting things about various items. So again, Thursday report, if you're interested in receiving it, just shoot us an email and we'll be happy to add you to the list, info@gassmanpa.com. And it's a useful thing that we offer clients and advisors and other individuals that we have contact with, which seem to make it helpful for them for their week. And then the last couple items of housekeeping, we just wanted to make sure you are aware that the next webinar we're producing is back with Alan, 8 steps to a successful Florida estate plan. And then following that, you've got Brandon coming in with a refresher for claiming the employee retention credit. And then finally, Chris will be coming in with understanding spousal limited access trusts. So this month you get the 4 of us. Hopefully I will not be the worst of what you see. All right, so turning to a qualified personal residence trust. That's what a Cupert is. Cupert, Qualified Personal Residence Trust. It's not Cupert. It's not the old video game that we used to have back when we played Ataris. For anyone that's a millennial, sorry to lose you on both of those references. So talking about Cuperts, so a person transfers a personal residence to a Cupert. So an individual, could be the husband, could be the wife, could be a single person, son, parent, doesn't matter, transfers a personal residence to the Cupert. Now, a personal residence is defined. One thing to note for both Cuperts and for Grats is that these are creatures that were created by statute. So therefore, a lot of the answers lie in the regulations. There's also some material that's been published in revenue rulings by the IRS to help you with items. But for the most part, this is an area where you're going to find definitions in the code and examples and explanations as to what you can and can't do in the trust agreement for both Cuperts and for Grats as well. And Grats, when we get to them, are grantor retained annuity trusts. But again, we like our acronyms, so we're talking about Cuperts right now. So a personal residence is either the principal residence of the grantor or one other residence of the grantor, or an undivided fractional interest in either of the principal residence or other residence of the grantor. So the way to think about this is that if I am single, I can give my homestead, my principal residence to a Cupert. If you live in Florida, the trust can be drafted, the Cupert can be drafted in such a way that during the retained term, which is we'll talk about in a minute, but during that retained term, it would still qualify as the grantor's homestead. And then after the retained term, if you're worried about qualifying for homestead, the grantor can lease the property under a 99-year lease from the trust and continue to qualify for homestead. So again, going back to my single individual, I could put my homestead into the Cupert, or another option is if I have a vacation property, I can put that into the Cupert as well. Now, what I mean by 3 is an undivided fractional interest in either can also be placed there. So in my single individual, let's say my brother and I inherited a condo on the beach from our parents, and we each own 50% interest. I can place that 50% interest that I own into a Cupert. The other option of using the fractional interest comes into play with married couples, and there is a benefit, and we'll talk about that in a bit, about transferring property that's owned by a husband and wife, 50% to husband, 50% to wife, and then each of husband and wife can transfer the property to their respective Cuperts. By doing this, you're going to get a fractional discount, which will make the Cupert more effective. All right, so it's important to note that it's a principal residence or another residence of the grantor. This is not available for commercial property. A personal residence can also include additional structures on the same parcel of land that are reasonable with respect to the purpose. So basically what that's saying is that if you have a house that's in the country and it's common for a barn to be included as part of the house, then that barn would be included as part of the Cupert. That's what it means by using additional structures on the same parcel of land. So it's not limited just to the house. If there are other parcel or structures on the land that are commonplace, that can be included as well. It's a little bit of a facts and circumstance test, but it's assuming that your residence fits in with the neighborhood, you're going to have no problem. All right, so again, one of the rules is that a client can only have 2 Cuperts at one time. Now, the reason behind this is just the fact that it's statutory. Now, if you have 2 Cuperts, there's another rule. One of the Cuperts must own the client's personal residence or a fraction thereof. All right, so if I place my primary residence into a Cupert, I can also place my vacation home into a Cupert. If I place my vacation home into a Cupert, I cannot place a second vacation home into a Cupert. The only other thing that I can do is create a Cupert for my homestead. All right, now these 2 Cuperts at one time, that is not a lifetime total. It's again at one time. So the Cuperts are for a set time period. When that retained period ends, the retained term ends, then you're free to do another Cupert. Now, again, you have to look at what the situation is, because if you have done a Cupert with your primary homestead and that Cupert ends, if you're already in a Cupert with a vacation home, unless you have a new primary homestead, you need to wait until the one Cupert is done with the vacation home before you can enter into a second Cupert. All right, so now with a Cupert, the basic idea is that you contribute property to a trust and you retain the right to reside on the property for a set period of years. This is called the retained term. At the end of the retained term, the personal residence then passes to the remainder beneficiaries. We typically favor having the asset pass to a remainder trust so that it could be protected from a beneficiary's creditors. The other option would be to have the property pass outright to the beneficiary. The downside of this, again, primarily is the fact that then the assets will be exposed to the creditors of a beneficiary. If the grantor dies during the retained term, the value of the primary residence is included back in the grantor's estate. A lot of the reason why we're doing a Cupert is to help transfer wealth from the main generation down to the beneficiaries and subsequent generations. We're trying to do this in a way to help maximize the estate tax exemption that's available for clients. So when you fund the Cupert, you are going to make a taxable gift, a reportable gift. And when you do that, you're going to file a gift tax return reporting use of some of your exemption. If the grantor dies during the time period, then the value of the house is included in their estate, but then they also do get a credit for the exemption that they use reporting the taxable gift. All right. Now, during the retained term, the grantor has the right to reside on the property, and the grantor pays all the expenses associated with the personal residence. This is taxes, insurance, maintenance, association fees, and repairs. So those expenses can be paid by the grantor. They're not deemed to be an additional gift to the Cupert. They're not a reportable gift. They don't use any of the client's exemption. They do help to use some of the client's other funds that would be subject to estate tax. So again, this is a benefit for the client in that they get to spend their own personal money to help preserve and improve the property, which is going to pass without being subject to estate tax. All right, so a couple other items on Cuperts. As a general rule, the Cupert should only hold the residence. They can also be funded with cash or other funds to pay for reasonable expected expenses, improvements, or for the purchase of the initial and/or replacement residence. So the payment of expenses and improvements must be within 6 months of receipt of the cash, and the purchase of an initial or replacement residence must be within 3 months of receipt of the funds. So what this means is that if I purchase a property and I know it's going to cost $100,000 to refurbish the property to make it the way I want to, I can purchase the property, place it into the Cupert, and also contribute $100,000 of cash to the Cupert, assuming that that money is going to be spent within the next 6 months on improvements. Now, the $100,000 that I contribute as cash is going to be an additional gift, meaning that when I file my gift tax return, the property value is going to be reported, and in addition, the value of the cash will be reported as well. So for many clients, they oftentimes just improve the residence ahead of time and then enter into the Cupert. Now, the 3-month limitation talks about initial purchase or replacement residence. In my experience, at least, our clients, we typically don't have them fund a Cupert with cash and then have the Cupert purchase the property. Either the Cupert's inserted on the contract for the purchase, or the property is transferred from the grantor to the Cupert. Where the 3-month play does come into play is that you have the ability, the Cupert has the ability to sell the property during the term, get the proceeds, and then reinvest those proceeds in a new property within 3 months that would be used by the grantor. In addition, if a residence is damaged, then the Cupert can hold the proceeds related to the insurance proceeds as well. All right. One item to touch on base quickly on this is that if you have a Cupert and you're worried about exceeding that 3-month period because of the property being sold or damaged and not made back to the way that it was, one item is that the Cupert can convert over to a Grat, which we'll talk about in a minute or two. And that way the estate planning can continue to work the way that it's intended to. All right, so I touched on that when you fund a Cupert, you make a gift. Now the value of the gift is equal to the fair market value of the personal residence minus the present value of the retained term. And I should clarify there that when I say the fair market value of the personal residence, if you give a fractional interest, then it would be the fair market value of the fractional interest of the personal residence minus the present value of the retained term. All right, so to determine the fair market value of the residence, because this is going to be a gift tax return, it is going to need to be filed with the Internal Revenue Service. To provide them with full and adequate disclosure, you're going to want to go and get an appraisal done on the property. That appraisal should be attached to the gift tax return. And then you'll also need to show a calculation with respect to how you determine the present value of the retained term. This is something that can be done on the commercially available software, or you can hand calculate it if you want to. To calculate the present value, it's based on the number of years of the retained term the age of the client when the trust is created, and the 75-20 rate. So the number of years of the retained term, that's the number of years that I reserve as grantor the right to live in the property rent-free while it's owned by the trust. The age of the client, self-explanatory, and because this is a mortality risk and it goes to impacting the value of the gift, and then the 75-20 rate. So as 75-20 rate, which is a rate that's published by the Internal Revenue Service, as that rate increases, cuperts become more effective. And we'll get to that point in the math in a few more minutes. So again, the transfer to a cupert will need to be reported on a gift tax return. For those people that are familiar with taxable gifts, there's something called an annual exclusion gift. That's a gift which can be up to $17,000 per person per beneficiary that does not need to be reported on a gift tax return. With an annual exclusion gift, you need to have a present interest. And unfortunately with cuperts, there's no way for a beneficiary other than the grantor to have a present interest, and therefore none of the gift will qualify for the annual exclusion. And that's why with a cupert, you always need to file a gift tax return. And with that, we're 15 minutes in, so I'd like to have our first polling question. And so our first polling question is, would you be interested in sponsoring a minority student to participate in Estate Planning Council? This is an excellent opportunity for students to be involved in local estate planning councils. It helps to show them what they might be able to experience in practice, and helps to see if they would be interested in this area of practice, as well as getting them exposure to a lot of individuals in the local community. So if you would be interested in this, you press yes, please. If you would like us to send more information on how you could get involved in this, please press B. And if it is not of interest to you today, simply press C. All right, so I thank everybody for their participation. And going back to the webinar. Okay, so what I'd like to talk about here again is the idea that we just touched on. We're going to make a taxable gift by funding the cupert. But again, we're doing this to help maximize benefits. And so one way that we can maximize the benefit is of a wealth transfer is by using less exemption to transfer the same assets. So one idea to consider is that if a husband and wife form separate cuperts, they can each transfer a 50% interest in a residence to the same, or to their respective cuperts. One of the biggest benefits on this is that, you know, when you talk to the appraiser, maybe you'll get a 15% discount for the value of a 50% interest in a property. Because the lack of control, lack of marketability, no one's going to want to purchase a 50% interest. Well, not no one, but very few people would purchase a 50% interest for a dollar for dollar, meaning that if the property was worth $200, I wouldn't pay you $100 for a 50% interest. Maybe I would only pay you $85 for that interest. And by discounting that 50% interest, we can then discount the actual value of the gift. Because again, remember the value of the gift, one of the components of that was actually the number, I'm sorry, you know, the value of the residence. So that's what we need to start with. Another item to think about too is that, as I mentioned earlier, if you do this as a planning technique and you die during the retained term, then all the assets get pulled back in. Now the chances of a husband and wife both dying during this retained term is obviously statistically less, especially if we take out something like a common car accident or something along that line. So therefore, you're hedging your bets by having a husband and wife form cuperts. One item to remember, and it's something that we won't have time to address today, is the reciprocal trust doctrine. And so what that means is the IRS says, I cannot create a trust for the benefit of my wife, and my wife create a trust for the benefit of me with identical terms, because at the end of the day, we're both in the same position that we were before we created trusts for each other. So therefore, the IRS unwinds those. So if you do have a situation like this, maybe husband creates a cupert for the benefit of spouse and descendants, and maybe wife just creates a cupert for the benefit of descendants. All right. Again, like we talked about, once the Cupert expires, the retained term is done, then the remaining assets can transfer to the beneficiaries, and you don't have to use any additional exemption. All right, so if the grantor fails to survive the retained term, then the grantor's estate includes the value of the residence. The grantor's estate gets a credit equal to the amount of the exemption that had been used when the gift to the Cupert was reported. And although you do not get the benefit of the transaction, you also do not lose any exemption when you fail. So it's essentially as if you never entered into the transaction to begin with. Like we touched on, if the grantor wants to continue using the property after the retained term is over, the client's going to need to pay full fair market value rent to the property. A couple of nice things on this. By paying full fair market value rent to the trust, the grantor is going to be decreasing his or her estate. Those monies that would otherwise be subject to estate tax in his or her estate will instead pass to the trust and be out of the estate tax system. In addition, because the trust can be structured as a grantor trust after the retained term, meaning that the trust is treated as being owned by the grantor for income tax purposes, even though it is outside of the grantor's estate, the payments of the rent to the trust will be ignored and will not generate any additional 1040 income that would need to be reported by the grantor, or any income on the 1041 that would need to be reported by the trust. So there's a big benefit to that, being able to rent the property. And like I talked about with a Florida property, you're able to enter into a 99-year lease, which if you take the necessary steps with the property appraiser, will continue to qualify for homestead, so that the property can be have the 3% cap that would be otherwise applicable to the valuation and taxation of the property. All right. And we just talked on about the grantor trust, about the income tax. One other item to think about is that the grantor can have the ability to remove and replace the trustee of the trust after the retained term, and that is not an issue. What's nice about that then is that the grantor knows they're not giving up complete control over the property, and they can put in another individual who hopefully would manage the property in the way that would be more consistent with their intentions if there was ever an issue. Again, if the property is sold during the term, then replacement property can be bought. Or if there's no replacement property, then, let's say that you have a vacation house in your Cupert, you sell it and you decide that you don't want to reinvest in another vacation house, then the proceeds of that sale can be converted to a Grat, a grantor retained annuity trust, which is the type of trust that we'll talk about next. And that conversion can occur, and at the end of the term, the assets would still be excluded from the estate of the grantor. All right. And then one other item to note is that if you do have a residence such as a beach house or a vacation house, under Florida law, that's not going to be protected like your homestead is from creditors. But by placing it into a Cupert, it'd be placed into an irrevocable trust, and that maybe, that'll afford better protection than simply owning the property outright as far as protection from creditors go. All right, so the impact of the 75/20 rate, when the 75/20 rate is higher, then the Cupert functions more beneficially for, I don't know if that's really a word, more beneficially. The Cupert functions better for the client. This is also true, obviously, if the client has property that's the real estate value is depressed at the time of funding and expected to increase later. So currently in this environment with the interest rates, the 75/20 rate has increased from 3% to 4.4% in the last year. And so as an example, if I had $1 million house, and in May of 2022, when the 75/20 rate was 3%, and I ran some assumptions, but basically using my assumptions with $1 million house, a gift might be $611,160. Using those same assumptions as far as age and term, but just simply changing the 75/20 rate to 4.4%, the value of the gift decreased by $533,970. That's over a $77,000 difference. So again, if a client was, you had two clients, and one client in May was thinking about transferring $1 million property and for a 10-year term, let's say, and then another client the next year was that same age, 10-year term, $1 million property, the client in 2023 would be using $77,000 less of his exemption or her exemption because of the change in the 75/20 rate. If you had a crystal ball over the last year, the best month to have done this, and again, taking out the value of the property, would have been in December of 2022. We had a 75/20 rate of 5.2%. That would have reduced the gift down to $494,000 based on these assumptions. That would have saved another $36,000. So it's over $117,000 difference between May and December as far as what the value of the gift would be. And again, that's something that you can't, predict. You can't go back and pick and choose. But in a month where the 75/20 rate is going to go up, maybe if that gets published and it's going to go up, maybe you postpone funding your Cupert until that month, a week or two until that month to get the benefit of the higher rate. Or maybe that's a reason, if the rate's going down, to get this done before the end of the month, before the rate actually does go down. All right, so what I've done here is, and I'm going to go through examples for the next 5 minutes. We've got a chart here, which I will walk through, and then following the chart is an explanation. All right, I've done one for 45, one for 55, and one for 65. Now the value of the house stays the same, $2,140,000 in all three of my examples, $2,140,000 and $2,140,000. In all three of the examples, I'm transferring 50% of the house. So that would be, transferring the 50% of the home like you see. I'm sorry, I apologize. There we go. 50% of the home. Now I'm back to where we were. So 50% of the home is $1,070,000. Applying a 15% discount, we're reporting the value of the home as $909,500. All right. Now what I've done for every individual is we have a 10-year Cupert, a 15-year Cupert, a 20-year Cupert, and a 25-year Cupert. And so you can see, and I'll just start circling here. So we have the 10-year, the 15-year, the 20-year, and the 25-year Cupert. For each individual down below, we've also calculated the probability of dying between a certain age. So this looks at the ability of the Cupert to function. Because if I die during the term, then everything gets pulled back in. So if I'm 65 years old, I have a 17.87% chance of dying before age 75. And what that'll do is 15 years, 32.23%, and 20 years, 50.894%. So this just shows you the statistical mortality rates. And again, it's important to remember that this is an average. If you are in better health, obviously you're going to live longer. Frequently, people that have access to significant funds have better health care, so maybe they're going to live longer than the average person as well. In each of these charts, and I'm going to go back to hold on one second, I apologize. I'm going to go back to, I'm stuck. There we go. Oh, I drew on every page too. Sorry about that. Let's take the erase all drawings. There we go. All right. So now going back to where we were, thank you for your patience here. And I'd like to start with the 45 one. So if I start with the 45-year-old, and here's where we are, we'll walk through this a bit and then we'll take our second polling question. So with a 10-year Cupert, if I go ahead and what I'll do is highlight this time. With a 10-year Cupert, so we're in this row here, the gift percentage is 62%. So 62.3% of 909,000 is 567,000. So that's the amount of the taxable gift that I would report on funding. What we've done here is we've shown that the value of the residence at the end of the term, assuming 7 years growth. So after 10 years, my $1,070,000 $1,000 residence, assuming 7-year growth, should be worth $1,789,000. If that was subject to estate tax, that interest, because I was subject to estate tax, then I would be paying 40% estate tax on that value, which is equal to $715,650. All right. Now, what I've already done is I've used $567,000 of my exemption on funding of the trust. At 40%, that would have saved me, roughly $230,000. Now, $230,000 is the exemption that I've already used, or $230,000 I've already used on funding of the Cuperts. That's why here, the total value of savings at the end of the 10 years is equal to $488,000. That's the actual estate tax that I'm saving that would otherwise be payable after the term of 10 years is up by using the Cupert. That's the benefit of the Cupert. And then if I further assume that I have another 15 years, so I project out to 25 years, I have 15 more years of the asset growing at 7%, and I'm also paying rent to the trust, and that rent would otherwise be subject to estate tax. The total value, the total savings over that 25-year period is equal to the 1.747 million. All right, so what I'd like to do is take a minute now to go to the next polling question, and then we will come back to the slides that we have here. So our second polling question: for every complicated solution, there is a simple solution, and it is A, the right solution, B, the wrong solution, or C, complicated solutions call for complicated, or complicated situations call for complicated solutions. So I appreciate everybody polling in. More importantly, I appreciate the fact that there are people polling in, which means that I haven't put you to sleep, that you're actually still paying attention, and that's good after half an hour. All right, so turning back to the slide, what we have here is the written explanation of the numbers. So I had just touched base before, like we talked about. I gave you the math examples here. So this is the math example of everything. Now, if we come down here, this is kind of the written example. So a gift of a 50% interest in the house, we're reporting is a $441,399 gift. And what I did for this one, this written explanation actually is for a 15-year Cupert, which you can see there at the top. So again, a $441,399 gift. So coming back, and that then corresponds with the 15-year Cupert, and you can see the $441,399 gift. All right. So then, if we go back to my explanation. There we go. Reported as a $441,399 gift. All right. So the home, 50% over 15 years grows to $2.5 million. The estate tax at 40% on $2.5 million would be the $1,003,736 that you see there. All right. On funding of the trust, again, we use the $441,399 for the gift. At 40%, this would be equal to a tax savings of $176,000. So if I had only put in cash of $441,000 and at a 40% estate tax, that would have saved me $176,000. So if there's no further growth in the house after 15 years, my savings is $827,176. So that's the $1,373,736 that represents the savings of the 40% of the value, reduced by the savings attributable to the exemption that I used, which was the $176,560. So in this example, my total savings would be $827,176 after 15 years. Now, if the house continues to grow at 7%, the total estate tax savings for another 10 years is $1,797,941, which you can see there on the screen. Now, how do we get that number? So from years 15 through 25, rent equal to 8% of the value of one half of the residence is paid. So that's a rental payment of $2,773,612. It's not subject to estate tax. So the estate tax savings on that is 40% of that number. It's not treated as an additional gift. There's no deduction associated with it. It's just a benefit to the beneficiaries, and it's transferring wealth effectively. So at the end of the day, if I pay rent for another 10 years, the balance would mean an additional 1.1 million of estate tax savings. If we add that to the original amount of estate tax savings, then our total amount of savings is equal to 2,907,386. And so what we've got is, when you look at these, and what's important to look at too, is that if we look at the estate tax savings after 25 years, you know, in this situation, if I was looking at a 20-year Cupert or a 25-year Cupert, I've got a 6% more chance of mortality with a 25-year Cupert than I do for a 6-year Cupert. And if I was going to be paying rent, the added value is only about $40,000. So for that 6-year or 6% risk of me dying in that 5-year period, to only transfer $40,000, it probably doesn't make sense. And again, you can see that theme coming through all the way through in all the numbers. Like, for instance, if we went to a 65-year-old, and let's say they were confident that they could get to, you know, to age 85, you know, they might be able to get there. But what about 90? Maybe they don't get to 90. They're only saving about $40,000. So, and when you calculate the rent, you need to calculate that, put that in as part of your calculation, because it's going to help to determine what the average length of the term should be and what's going to be most effective for your client. A couple other items on Cuperts before I turn over to Grats is that you have revenue procedure 2003-42. And with the Cupert, that provides sample provisions that you can use in your trusts. It helps address some of the issues and some of the items that you need to make sure you have. I've also provided some sample language that we have in our trust, such as the prohibition on sale of the grantor, which is required. We do provide a limited power of amendment, which allows the Cupert to be modified, but so long as it still qualifies as a Cupert. And then we have our homestead property provision, which allows it to qualify as homestead during the retained term. So those are just some various items for your consideration, as well as the language that we use after the retained term to help show that the grantor could rent the property if that's acceptable to the trustee. And again, the grantor can change the trustee in the event that the trustee is not administering the trust in the way the grantor wants them to. All right, so with that, we're going to turn over to a Grat. Now, a Grat is a grantor retained annuity trust. So with a Grat, what happens is that I contribute assets to the trust, and for a retained term, I get the right to receive a regular payment. The payment must be made each year. It can be made more frequently. Some clients prefer quarterly. Others say that you know, the annual payment's enough because they don't want to have to deal with the administration, et cetera. All right. Then when you have the payment, it can be expressed as a dollar amount, or it can be expressed as a percentage. Typically, we would express it as a percentage because then that way, if there's a change in the funding, the amount of the funding, the value of the funding, because of, say, an IRS audit, then the taxable gift is not going to increase. Because similar to a Cupert, when I make a contribution to a Grat, I have a retained right. That's that retained right to receive payments back from the Grat. That can be valued based on present values. And then that right is subtracted from the total amount that I contributed to the Grat to determine the taxable gift that I made on formation on funding of the Grat. Because similar to the Cupert, a Grat will not qualify for the annual exclusion gift exemption. So you are going to have to file a gift tax return when you file a Grat, with the exception being, and it's a big exception because a lot of people use this exception so that they do not have to file a Grat, is that you can create a Grat, what's called a Walton style Grat. Walton style Grat means that Grat payments come back to me for my lifetime. If I die during the retained term, they're made to my estate. And because of that, the Walton style Grat no longer has a mortality risk. And therefore you can have the payments back to the grantor equal to the total amount that was contributed by the grantor. So there's no gift to report. Some practitioners still go ahead and report the transfer to the Grat or report a transfer to a Grat with a $10 gift or some de minimis amount to help start the statute of limitations running. Other clients and other practitioners prefer to have the Grat be zeroed out so that there is no transfer that needs to be reported to the IRS. We did have one question come back in about how is rent determined for a Cupert. Rent, we typically peg it at about 8% or so of the fair market value of the property. It should be the fair market value of the property, certainly not the just value or taxable value rather. You can use, the property appraiser. In a perfect world, maybe you get a broker opinion letter to document the value. At a minimum, I would suggest saving Zillow or something else in your file to help determine what the fair market value is. If you had transferred a partial interest in, that discount would have been applied on the actual valuation report for the gift tax return. You could apply that same discount and then back into what the rent would be. So again, the rent's going to go up or down. I mean, assuming the property goes up, the rent will go up. But if you just peg it at, like, say, the 8%, that seems to be a good rule of thumb for us. So turning back to the Grats, when a Grat is funded, the 75/20 rate determines the value of the payments back to the grantor. Now, unlike a Cupert, with a Grat, as the 75/20 rate increases, the Grat becomes a less effective transfer tool. The 75/20 rate is still historically low, so Grats are still effective. They're just a little less effective than they were a while ago. All right, so again, the gift tax return or gift tax could be imposed on the value of the Grat. It depends on how it is structured. If it's zeroed out, then you're not using any gift tax return assets. Once the assets of the retained term, once the retained term is done, the value of the Grat assets can be held for the benefit of the grantor's spouse, and it could be also held for the benefit of beneficiaries. Whatever they want to name, that's fine. Similar to the Cupert, if the grantor dies during the retained term, and a little bit of a difference is that only some of the value of the Grat assets comes back. What happens is the IRS will calculate, or you'll need to calculate, the value of the retained term payments at that point and what assets are needed to make those payments, and that is the portion of the Grat that then would be included in the grantor's estate. So unlike the Cupert, it's not an all or nothing, but similar to the Cupert, if you die during the term, you're going to have at least partial inclusion of the assets. All right, and Grats are disregarded grantor trusts, at least during the retained term. So again, as far as reporting purposes goes. All right. Grats are statutory, similar to Cuperts. So again, you need to look through the code and the IRS rules and regulations and discussions associated therewith to make sure that you fit all the rules and the restrictions that are applicable. There are certain rules that need to be followed. All right, a few examples include the following. Again, it's not an exhaustive list, but it includes some of the main ones. You cannot add assets to a Grat after it's initially funded. If you're worried about getting everything funded on one day, an item we mentioned later is consider forming an LLC, funding the LLC with all the assets, and then once the LLC is fully funded, transfer the ownership of the LLC to the Grat. That gets you around the one-day funding restriction. When the Grat is required to make a payment back to the grantor, the Grat has to make a payment to the grantor. It cannot issue a promissory note back. So if the grantor or the Grat doesn't have enough cash, it needs to transfer over securities or a partial interest in the property that it received. This could lead to valuation expenses. If you have to transfer a partial interest, you're going to need to get an updated appraisal at that point. So keep that in mind when you're considering what to fund the Grat with. And another item is that the Grat cannot prepay or cannot commute the payments to the grantor. Again, there's no wiggle room, no ability to budge on these items. These are requirements of the Grat based on the statute and the IRS rules and regulations. All right, during the Grat term, only the grantor can receive distributions from the Grat. There can be no other beneficiary of the Grat. The Grat payments need to be made annually, and they have to be made within 105 days of the anniversary date. So there is a little bit of wiggle room You can make that payment 105 days late, but just make sure it gets made, because if you don't make it during that wiggle room, that grace period, then you've no longer have a Grat, you failed, and the assets will not transfer the way that you expected them to. Right, as touched on in the beginning, the annuity payment has to either be a fixed amount or a percentage. It is of the value of the assets originally contributed to the Grat. So at least with a Grat, to determine the payments that are coming back to me, I know what the payments are going to be based on the day one funding. Again, I might have to get valuation reports updated if I'm using assets that are hard to value to satisfy the payments, but the actual payment amounts should be determined based on the day one funding. Unique thing about a Grat is when I structure my payments back to me, I can make them level payments, or I can have the payments increase by 20% each year. If they increase by more than 20%, I only get the credit for the 20%. So you never want to increase by more than 20% per year. But if you backload a Grat by doing it that way, the effect is more beneficial, which is something we'll see on the slide in a couple of minutes. And let's just get through this slide first, and then we'll stop for a polling question. Now with a Grat, one item to note is that if you're thinking about generation skipping, meaning you're trying to use some generation skipping tax exemption to allocate the funds so they could be held in trust for the benefit of grandchildren or more remote descendants, with a Grat, that can only be done closer to the end of the retained term or at the end of the retained term. There's something called a estate tax inclusion period for any trust that could receive GST allocation. And during a period in which there's a 5% or greater chance that the assets could be pulled back into the grantor's estate, the grantor cannot allocate GST exemption to the trust. So that's why the GST exemption allocation needs to happen at the end of the term. And then, like we talked about, the grantor passing away during the retained term, some of the assets are going to be included. And then finally, similar to the Cupert, it is not going to qualify for the annual gift tax exclusion. I apologize for the typo there. Because the Grat is a future interest. All right, and we do have a quick question. If there are no estate taxes as a Cupert or a Grat still useful? I would say probably the Grat I don't know that it's useful in the sense that you could just gift the assets and be done with it. Or they could just, if there's no estate tax issue, then the assets could be kept in the grantor's estate and simply pass on death. With a Cupert, one of the benefits that I could see is what we mentioned before, is the fact that you could have a trust that would own a secondary residence, which could provide additional creditor protection for the grantor of the trust. So again, that was just a question that just came in. So now we'll turn to the polling question, third polling question. I assist with estate planning as a lawyer by encouraging my clients, by being an integral team member, or by wishing I had done this before they died. So hopefully it's not D. If it is, we might want to consider changing a few things. And as far as A, B, and C go, if you are an attorney, I think A and B hopefully are going to be in lockstep with each other. It seems like those would go together and could almost be combined as one. Integral team member, I guess, depends on the size of your firm, if you're a sole practitioner and how your firm is structured. But hopefully, if you do need to be part of a team, you are part of that team and not riding the bench. All right, so let's turn to some more slides on the Cupert. This kind of shows a basic idea, I'm sorry, of the Grat. This shows a basic idea of the Grat. As a grantor spouse can create a bypass Grat. What this means is, let's say I contribute $4 million to a trust for the benefit primarily of my wife. Distributions can also come out for my kids, and then remainder trusts for the beneficiary of the kids after my wife's passing. When this slide was prepared, if I zeroed out a Grat and I used a 20% increase on the payments, the first year payment to me would be 47.84%. The second year payment would be 57.41%. Again, it is of the day one value of the funding. So by using those payment amounts based on the contribution of the $4 million, we get into the payments that come back. And so you can see those there, assuming a 10% per year growth in assets, which I know seems a little bit large in today's environment, especially. After 2 years, $438,000 would pass to the remainder trust. With only 5% growth, 103,000 would pass to the remainder trust. In today's dollars, not today's dollars, but basically using today's numbers, the payment would have been, in today's dollars would have been, or numbers based on the 75/20 rate, 1,942,000 and 2,331,000. So you can see it's within 1% of what we had before. So it is still an effective strategy, even though the prior slide was done when the 75/20 rate was lower. All right. Now, if we look at the difference between front loading or doing even payments. So grantor places $1 million of cash into a Grat, and grantor takes back the right to receive $200,000 per year for 5 years. If we do that, that $200,000 per year for 5 years right now, at the end of that term, there would be $252,000 worth of stock in the Grat. All right, but if you did do that structure it this way with $200,000 per year for 5 years, what's going to happen is that the taxable gift would be $119,560. So I'm going to get $252,000. I'm going to transfer on funding at the end of my death, but I'm going to use up 119 of exemption to get there. Now, if what I did is I structured it for 5 years, and I could structure it so it would be zeroed out, meaning that I wanted to not make a taxable gift on funding. So if I structured it for 5 years and I increased the payments from $200,000 to $227,000 per year, and I misspoke earlier, this one is the same idea in that I have 5 level payments. So if I have 5 level payments, but I increase them to $227,160, now I've zeroed out the Grat. So even though I might not pass as much wealth as I would under this example here, I also don't have to file a gift tax return, and I haven't used any exemption. All right, now Grats are very good for small businesses. If you have a small business that's kicking off income, consider transferring a portion of that to the Grat. This runs through some numbers which were specific to that partner, but showed that it would be a very effective strategy because then the Grat can use the income that it receives to hopefully make the payments back to the client, and at the end of the term have the interest in the entity residing in the Grat without using exemption and maybe some additional cash as well. Okay, so a couple of other items that I want to talk about is we talked about a zeroed out Grat. One couple other items, because I'm running out of time. It's 11:52. The hour always goes by quickly, at least on my end. I'm sure it's dragged by on your end, but thank you again for staying with me here. All right, so front end load the Grat because again, the Grats can increase by 20%. So if we have Grat payments increasing by 20% per year, and let's go back, this is the first slide. So we have a zeroed out Grat, and we're gonna have, let's see, I apologize. Zeroed out Grat, it's gonna pay the grantor $255 a year and receive the $300,000 from the company. At the end of that year, it's going to end up with, or end of the 5-year period, it would have about $222,000 and 30% of the stock it zeroed out as far as it goes. Now, if I did a 20% increase in that, the Grat's going to have another $202,000 of assets plus the 30% ownership. And that's because the payments go from $175 in the first year, $174 in the first year, up to $361. But because the payments in the beginning are smaller, that leaves more assets in the trust, which can grow exponentially. All right. So what I'd like to do, and I have some ideas as far as funding, which you have there, is I'd like to just show the math on a couple of these items, because I think that that's good to go through in the last 5 minutes or so that we have. So fixed payments versus 20% payment increases. All right. So here I've got a Grat. I put $1 million in, it's a 10-year Grat. Both of these Grats are zeroed out and both assume a 6% increase in the asset value. To zero out a 10-year Grat right now, based on assuming they're a Walton style Grat, again, we don't have to deal with mortality, so it doesn't matter what the age of the client is when we're dealing with a Grat. If I've zeroed it out, to zero out a Grat right now, $1 million, 10-year payments would have to be $125,758. If I increase the payments by 20%, I increase that, I start with a payment of $51,564. Because of that, if you go to the end, you can see that Grat number 2, by having the 20% increase in payments, passes 169,000 of wealth, almost 170, compared to 133,000 of wealth for the same payments. So again, this is the same investment strategy. The only difference is that the payments back to me, instead of being level, increase by 20%. So it's pretty much a no-brainer that when you do a Grat, you should have the payments increase by 20%, unless there's something really unique about the situation. But as a general rule, it's going to be more helpful to the client having that increase. All right. So next thing I'd like to talk about is a 10-year Grat versus 5 2-year Grats. So with the 10-year Grat, and these numbers are a little bit skewed comparing the 5 2-year Grats, because I don't have all of the valuation in there as far as the assets appreciating. But what you can see here is with a 2-year Grat, 5 2-year Grats rather, if I kept contributing $1 million, at the end of the 5 2-year Grats, I'd get to $165,000 passing total, versus 169,000 for the 10-year Grat. All right, so again, they're pretty close to each other. It's not exactly apples to apples and oranges to oranges, but it's a pretty close combination of the two. What I did here in the right-hand side, the 129,364, is simply the 25,000 roughly times 5 that gets at the end of each of the terms, but then I grew whatever was left at the 6% rate. And that's why the total value at the end of the 10 years would be equal to 165. All right. Now here's the big difference for 10-year versus 5 2-year Grats. Is in this example, I had everything growing at 6%, right? Now that's not realistic. So if we go to the real world, what might happen with Grats is that you might have growth rate of say 8, 2, 12, 6, 2, 2, 10, 6, 3, and 9. So I took those same growth rates over here, 8 and 2, 12 and 6, 2 and 2, 10 and 6, 3 and 9, and broke them out, okay? What happens here is that now we've got a total under the 10-year Grat of $158,000. On the right-hand side, the first 2-year Grat worked pretty well. We have 23,000 with an 8% and 2% rate of growth. The second-year Grat had a 12% and 60% rate of growth, worked really well. I've got 89,000. The third-year Grat with 2% and 2% growth didn't work. I have 0. The payment back to me exceeded the assets that were placed in. But I'm not out anything. I didn't use any estate tax exemption. There's no issues with anything there. That didn't work, that Grat. The other 2 Grats did work, however. And when you combine that and you show the growth of the assets, you can see down here at the bottom that the total was equal to 246, which is significantly more than the 1 Grat over 10 years doing the 5 for 2. All right, and so in the last couple minutes, I just want to go over a couple more slides here. Now, one more slide is with a 10-year Grat, and I have it owning 2 different stocks. All right, so I have stock 1 on the left. We're going to say it began with 500,000 of value. It continuously grows at 6%. Stock 2, 500,000 of value, continuously grows at 2%. And then I have my Grat payment of 51,000 up to 266. I'm taking half of each annual payment out of each stock. So I take half of my 51,000 out of the Grat or stock 2, which reduces the 510 down to 484, and half of the 51,000 out of the stock 1, which reduces the 530 to 504. So if I do that at the end of the 10-year term, you can see that my Grat fails. I have a negative number. Now again, the Grat doesn't owe me anything. The Grat just didn't have any assets left to transfer. So at 0. Now using these same numbers, if I have 2 separate Grats and I've divided my payment, so 25,782 times 2, you see the 51,564 on the right-hand side of the Grat payment. Now I have it coming out of each account. And what you see is that the Grat B account with stock 2 fails even worse, okay? But you can't get less than 0, so there's no issue with the Grat 2 failing. Stock 1 in Grat A didn't fail. That actually transferred almost $85,000 worth of wealth. So in this same exact situation, if the clients had formed 2 different Grats because they had 2 big positions, instead of combining it into 1 position, they would have transferred $85,000 worth of wealth by doing the 2 Grats, whereas they would have transferred nothing by doing the 1 Grat. All right, so then the last thing is, and we don't have time for it, but we have a concept called the Scrat. And what the Scrat is a combination of combining a self-canceling installment note with a Grat. I've got material here showing it in a diagram form. We've got an article that we wrote on it, and then also a second fact pattern with additional items in there. Welcome any questions that people might have on it, and feel free to send us an email if you have any questions on that. We'll be happy to walk through it with you. And with that, it gets us to our final polling question, and that today is, which book would you like to receive a PDF of? And we have 4 choices: 8 Steps to a Proper Florida Trust and Estate Plan, How to Grow Your Medical Practice, which was written by David Finkel, Parikh Singh, and Alan Gassman, Creditor Protection for Florida Physicians, and What Estate Planners and Others Need to Know About Bankruptcy. So I appreciate everybody's attention and the fact that I still have people polling, which is always a good thing. And with that, I have gotten you to 12 o'clock. So as Alan would always say, I hope the rest of your day is billable. And hopefully, in addition to that, you're able to enjoy some of this great weather and have a fantastic weekend. And thanks very much, and we look forward to seeing you next week.